Thanks so much for joining us. I'm Josh Bartholomew. As we kick off 2019 here at Horizon Investments, we want to wish all of you a happy new year. In a few minutes, we're going to get to the markets and talk about recent market volatility and what to look for in 2019. But before we do, I wanted to start, as always, at the beginning of the year with our CEO, Robbie Cannon. Thanks so much for joining us.
Hey, thank you very much.
Robbie,
Josh.
there's a lot happening, and we're going to get to that with Scott and Greg in a few minutes, but there's a lot to be excited about here at Horizon Investments. I think you'd like to talk about kind of where we are in partnership with advisors.
Well, I mean, we've grown significantly in 2018, and not only are we really excited, but particularly we're just grateful for all of the growth that we've seen from a national perspective, whether we've added registered investment advisors or new broker dealers. We've gotten a lot of really good feedback from the marketplace and just really excited to serve.
Well, we've heard you talk a lot in the industry about this being the time of the planner. I mean, this volatility we've just gone through at the end of the year really speaks to that.
Well, it's not only the volatility, but it's also the demographics in terms of we're looking at problems that they're longer than 5 and 10 and 15 years. These are 20-year problems that we're asking advisors to solve in terms of retirement income. And so when we see volatility, it's very important to put it in the context of planning.
Well, if you could give any advice to planners as they encourage their clients, what would it be as we head into the new year?
I mean, there's always one phrase that sticks out anytime there's market weakness, and specifically in this quarter, is that small investment changes have large planning ramifications. And that's not lost on our audience, it's not lost on the planning community, but it's difficult, obviously, in an environment where you have a lot of volatility and certainly weakness in the markets, but some sort of disconnect with the fundamentals of the market.
Well, Robbie, thanks so much for taking some time to join us. And well, let's go now and talk specifically about markets with Greg Valliere and Scott Ladner. Well, with me now is Scott Ladner and Greg Valliere. Guys, thanks so much for joining us. You know, Scott, in 2018, a lot happened, but the real story was in the fourth quarter and the volatility. Why don't you give us your perspective on what happened?
Yeah, the fourth quarter was an incredibly interesting quarter. Very challenging, obviously, from a risk market perspective. But we think the thing that was the most important was probably the least appreciated, and that was the liquidity environment within which markets were operating during the fourth quarter. This was a quarter that saw liquidity in futures markets and high yield bond markets and everywhere else exhibits really, really poor and thin liquidity conditions. That serves as the backdrop for a quarter that had a lot of selling pressure associated with it. Selling pressure coming from retail accounts, people scared about recessions, coming from investment managers, professional investment managers reallocated away from equities towards bonds to the tune of 15 percentage points during the month of December. We also saw systematic strategies play a role, especially in October, probably more in October than in December, but things like CTAs and trend following strategies, volatility targeting strategies, risk parity, those types of things. All of that selling pressure was basically one way. And it happened in an environment where liquidity was, frankly, very thin. There are not a whole lot of buyers. That kind of an environment can set up to be a very whippy and violent price action market. It's what we got in December. Doesn't mean that was necessarily reflective of all reality, but that was an important driver for what happened.
Well, that's a good market perspective, but Greg, Washington certainly didn't help.
Lots of thrills and chills, absolutely. And I would just say, Josh, what a difference 1 month makes. Because in December, at the depths of the market anxiety, you had things that look better now. I think fears of a recession were overdone. I think a recession is still very unlikely. You had great anxiety over the Fed, and I think the Fed has made it clear they're not going to touch the hot stove of interest rate hikes anytime soon. You had tremendous uncertainty about a China trade war, and I think in the last few days it's become clear they're making progress. Still more work to be done, but it's headed in the right direction. And in December, people were worried about a lengthy government shutdown. That may drag on for a few more days, but I think even there's a chance for a deal.
So the things we were most concerned about all of a sudden seem less worrisome in the first quarter here.
You can't get wildly bullish about Washington. It's a pretty dysfunctional town right now. But I think that the really strong anxiety we saw a month ago has faded a bit.
So Scott, Greg used this word uncertainty. The last time I can remember real uncertainty affecting the minds of investors was that 2015-16 time period. Can you draw some comparisons and maybe contrast that market versus today?
Yeah, we do think actually some pretty instructive comparisons with respect to that, these two periods of time. If you remember back in 2015, 2016, we had some pretty severe global growth concerns. fairly well founded. Everything was kind of slowing down. We have there's some kind of global growth concerns today. Not sure that makes quite as much sense, but they're definitely there. And then in August of 2015, we had a central bank policy mistake. The Central Bank of China devalued their currency and surprised the world with that. They did it again in December. And that central bank policy mistake started the selling, started the risk-off mode. The thing about markets and selling stages that start with central bank policy mistakes is they have to be fixed with a central bank policy fix. And in February of 2016, we got the Shanghai Accords, which was essentially a currency detente. And that really solved that period, that episode. This period of time, we had Powell make a communication error in an October 3rd interview with PBS, where he hinted that the Fed is going to raise rates much more quickly and much further than the market was expecting. That really started the selling. This past Friday, we might have gotten the central bank policy fix for that error that was going to be necessary to end this episode, when Powell signaled that there might be a lot more flexibility inside the Fed. They may take account of markets in a much more robust fashion than they previously were thought to be doing.
So guys, let's take a moment and make some predictions. Greg, we'll start with you. Your town, what does it look like in Washington at the end of 2019?
Well, as usual, very divisive. I think 28 or 29 Democrats will run for president. They'll all be sniping at Donald Trump. We'll see a lot of that this year. Let me make this point about what I think has changed in Washington just over the last few weeks. The markets are really dictating policy. The markets went to Jay Powell, not Donald Trump. The markets went to Powell and said, enough is enough, and he got the message. The markets have gone to Trump and said, we don't want a trade war with China. And I think that Trump wants to get reelected, and he knows he's got to have happy markets. And if we can resolve the Chinese trade story, the markets could be a lot happier.
Well, Scott, from a market perspective, we've had this volatility, but the beginning of the year looks pretty good. What's your prediction for the year?
Yeah, it does. And you know, I think Greg's point about the trade war, having some sort of truce or resolution to that is going to be pretty important. You know, in our experience, deals that get done, deals get done when both sides need to get done. And both sides definitely need a deal to get done on this China-U.S. trade war. If that gets done, we have that combined with a backdrop of a weakening U.S. dollar. The dollar should come down as the Fed expectations get priced lower. That's supportive of risk markets. And then let's not forget that we have pretty strong earnings and sales growth in the U.S. So S&P 500 sales growth is still going to be 8%. Earnings growth about 6% this year. You know, we're not going in an earnings recession in the S&P 500 this year. So all of those factors combined should lead us to believe that this should be a reasonably good year for risk markets.
Well, guys, thank you so much for taking some time. It's nice after what we just went through to have some things to be optimistic about as we head into 2019. As I said at the beginning, thank you all so much for taking the time to join us. And as Robbie said, we're very grateful for your partnership. We look forward to serving you in 2019. Stay with us. Stay tuned. We'll be back with you at the end of next quarter. All of our content, by the way, is available at horizoninvestments.com. You can also reach us if you have questions about Horizon or its goals-based strategies at 866-371-2399, sales@horizoninvestments.com. Don't hesitate to look at our new tech tools. They've been updated and refreshed throughout the last 6 months. I think you'll find those helpful as you position Horizon with your clients. Thanks again, guys, and thank you so much for joining us.